I'm just not a person who's really prone to be failure minded. I have had failures, but that's just an opportunity to learn something new and get up and move forward. So from the inside out, that's just the way I think. So there is no permanent failing. You just keep going. You take what you've learned, you reapply it, you get some good counsel from people, say, hey, look at my model here. Can you tell me what I might do differently next time or what I did wrong that time?
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else with your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grinzik. With me, as always, is John Cohen. How's it going?
We're good. I almost set a record. I almost got a new shelf completely built in between, right before coming on here. So it was I'm one draw away. I was under the gun, but I got this close.
Nice. There you go. Is it IKEA, Wayfair? How in depth are we talking?
Amazon Prime Day. It had like the most ratings on Amazon, and
one of those.
Actually, suckers. Yep. I actually got the first one built. I put the draw, and I said, fuck, I did it backwards. And then it clicked. And then I was like, I didn't. This is fantastic. So I actually built the entire thing. No questions. I got one draw to go. So I was very excited. I opened it up and my daughter was running around. There's pieces everywhere. I said, oh God, what did I do? This is a Sunday project, or Saturday project, but I was able to get it done. So I'm excited.
I still got one dresser that I did from IKEA. I put the tracks on backward. And when I went to undo it, I totally stripped the screw. So the thing's stuck. I can't get it out. So I've got this raggedy looking dresser with a drawer half hanging off that doesn't even work. So I hate those things. I got to upgrade to some actually decent furniture for once.
Yeah, this was highly rated, right? Whatever. We'll see what happens. My desk has been piling up papers through COVID. I was getting sick because I'm a little bit of a neat freak. Mm-hmm. And I said, I gotta redo this office. I gotta clean it up. I gotta get a better desk. So this was step one, so I'm excited. the little things that you get excited about.
Exactly. As you get older, right?
Exactly.
But let's jump into today's episode. I think it's going to be a really awesome conversation. I'm excited to hear more about it. It's a space we haven't really talked too much about. We did it a little bit with, what was his name? The guy that was on Charles's thing. Remember, he was in the note space as well. I can't remember his name. It'll hit me later, but I think we're going to have a really interesting conversation because it's not, as popular of a space, especially in the online podcasting world. So I'm excited to talk with Jim and learn a little bit more about it and probably ask some questions that I've been dying to get answered. And I know it's a space you've dived into a little bit as well. So with that being said, Jim, thanks for coming on.
Yeah, absolutely. Great to be here with you guys.
Yeah, absolutely. So you want to kick things off, just tell everybody a little bit about you, where you're from, your background, what you do.
Yeah, sure. So name's Jim Maffuccio, and currently I'm the co-founder and principal of Aspen Funds, and we're a distressed debt investment fund company, mortgage funds. Just backing up, I've been self-employed, I should say, full-time in the real estate world since 1986. And no, I didn't start when I was 5 years old. I'm a little older than that. So I actually was an engineer in the corporate world for 6 years prior to that, from 1980 to 86, and worked for the largest corporation in the world at the time as an engineer. Learned a lot of project management, realized pretty early on that the corporate gig wasn't for me. And so I got my real estate license while still employed with the company, and set out on my own, and welcome to the world of, you eat what you kill.
There you go.
That's been happening since 1986. I was mostly a residential developer in Southern California, which is, insanity in and of itself, just putting those two phrases together as a small fish in a very large pond, and a very highly regulated environment. And so what that all means is that it takes a really long time to get projects approved. So you don't really know what your market's going to look like by the time you raise the curtain and have your product ready. And that kind of gives you a hint into my couple decades of failing forward. Really, I had some hugely successful projects, and it's feast or famine when you're in that world, when you're doing land development. If you hit the timing right, you're gonna make strong seven figures. If you hit the timing wrong, unless you're deep pockets and you're doing everything cash, which is pretty rare in the development world, that debt is going to turn around and chase you down the hill and gobble you up. And so basically that happened to me twice. I didn't learn my lesson well enough the first time up the hill. So basically an S&L related, the S&L failure was the first time it took me down. And then I decided I'd double back around and try it again. So shifted all my focus on affordable housing. So I thought that would be the safest, because you're not going to have the bubble bursting situation. And, it's all relative, like what's a bubble and what's affordable. So by the time I got out in the the 2000s, the 2008 mortgage crisis, I was, broke, beyond broke, in my mid 50s with 5 teenagers in tow, and moved from California to Kansas City to the heartland, and literally started, flipping houses with, raising money from people I didn't know and flipping houses to start over from scratch at 55 years old. So, I discovered the debt space. Actually, I discovered debt, from day one, but I discovered I was on the wrong side of it. So, debt can be a really good thing if you're the lender. I've found out, I've determined. So I started retooling in 2010. I went to a distressed debt conference, and that was in Denver, Colorado. And the lights kind of came on for me, and I realized, wow, I really understand all the moving parts here. I just have to rearrange them a little differently. And so I studied it for about a year. And then in 2011, I jumped in and did some little beta tests. And what I mean by that is I started buying some non-performing residential mortgages, and they were everywhere at the time. I mean, the institutions were hemorrhaging this paper. Remember they used to call them toxic assets. Mm-hmm. So those toxins became my treasure, and started buying them with a handful of new investors. And then I joined up with a business partner in 2012. He had been a guy that had scaled businesses. He had the fastest growing tech company in the Midwest in the 90s, won the Ernst & Young Entrepreneur of the Year Award. And so we had a cup of coffee one day. He said, well, tell me what it is you're doing. And I told him I was buying non-performing second mortgages. Mm-hmm. And he looked at me like, are you insane? I said, give me 5 minutes to explain. And I did. And the lights came on, and he said, wow, he goes, this looks like a rich vein. Let's do this together. I'll go raise the money and do all the business side of it, the back office, and you go ahead, find the deals and work the deals. And I realized, man, that's the part I love doing the most anyway. And up till then, I'd pretty much been a one-man show as a developer. I would just hire everything out and do it all myself, the coordination. So this was a new thing for me to actually recognize that there's actually other people out there that are really better at things than I am at those particular things. Like, for instance, putting furniture together, guys. Little clue for you there. Yeah. So anyway, it's been great since then. We built this company since 2012. It was literally me and my son in the basement of our home in Kansas City in 2011. And here we are today. I have 2 of my sons working for me. We've got about 25 people spread around the country, and full-time employees. And we're really rocking it. We've just had some really super blessed years here, and we've been growing. We've doubled in the last year. We've added 6 people during COVID. So, we're scaling our business right now, and it's just been a wonderful season, and there really doesn't appear to be any end in sight for the field that we're in. So that's the, 5-minute or maybe 10-minute.
Oh, that's awesome.
Yeah. So I want to ask about something before we get into the real estate stuff. And I think it's important because so many people you talk to about going to the eat what you kill model, the entrepreneur work for yourself model, is there's always that hanging over your head, that failure, and you don't have a salary or a job to fall back on. And you use the term that I love, which is fail forward. I mean, talk about, I don't want to say the wrong term is worst case, but a scenario that a lot of people don't want to get into is ones that you've experienced of being 40, 50 years old, having quote unquote failures and having to figure it out. What was that like for you? How did you get through it? How did you come out the other side swinging, basically?
Yeah, great question. So really a combination of factors. I mean, one is, you actually learn, you learn how to do things when you're in business. Usually you're in a business that actually gives you some actual transferable skills. And I certainly had those from going all the way back to my engineering days, but then being around real estate, I mean, you kind of figure out how things work, and so you have the moving parts. And so maybe the model that I put together the first couple times, I didn't have any mentors, and I'm not a victim there. I mean, I should have gone and found them. That's a big deal today. You can find people in almost any field with a couple clicks of a mouse. We didn't have a mouse back then. Mouse back then was something you kill and throw out with the trash. So, but I probably could have been coached and built a different model. But all that to say, I did learn some raw skills. So I carried those with me. You get something for 20 years of ups and downs. Probably I'll just say right up front, what really informs all of my life is, I call it my core, and that's my faith in God. I mean, that's what everything. It's very real to me. It's not just a religious disconnected thing. It's like when you go into the gym, you want to work out your core because that's the center of your being. Well, that's the way I live my life. So I kind of live from the inside out. So by definition, then I'm just not a person who's really prone to be failure minded. I have had failures, but that's just an opportunity to learn something new and get up and move forward. So from the inside out, that's just the way I think. So there is no permanent failing. You just keep going. You take what you've learned, you reapply it, you get some good counsel from people, say, hey, look at my model here. Can you tell me what I might do differently next time, or what I did wrong that time? So I think there's a certain kind of personality. I mean, not everybody's supposed to be an entrepreneur. Not everybody's supposed to own their own business. Most people aren't happy owning their own business, and they realize, wow, I just built myself another job anyway. So for the people that actually are to be entrepreneurs, I think most of us probably think pretty much alike. If I were to ask you guys the same questions, I think I'd probably get a lot of the same answer. It's like, look, failure is a temporary deal. Things are supposed to work, that that furniture you're putting together, it's actually supposed to work. There's usually a parts list and some instructions, and maybe you used it, maybe you didn't, but so we keep working at it. And honestly, it's just in my case, it was, I just got some of the pieces out of order. It's like, hey, I'm on the wrong side of the piece of paper. I'm the borrower instead of the lender. You drive through a city. You drive through any major city and you look at like what the names are up on the buildings, and they're not flippers and rehabbers and wholesalers. And hey, I love all those guys and I've done all those things, but they're typically banks. And so, hey, when you're getting on in your years, it's like, look, I don't have too many rodeos left that I feel like doing. So I want to do one that's a little more conservative, a little more, steady. I can build the thing steadily. And so it's made a lot of sense for me. So I think a lot of it's attitude and just reapplying your skills and knowing that you're supposed to be in this world of eat what you kill. I love eat what you kill, even in the difficult years. It's still, to me, it's just real. I like getting up, putting my hand to something and getting real live feedback as to whether I'm doing it well. And, you guys know as well as I know, in the business world, you get reality feedback. You can hide as an employee. You can hide behind politics and making a good showing and saying all the right stuff. But when you're in business for yourself, hey, having some slick lines doesn't hit the bottom line. You have to know what you're doing and you have to apply it. So
yeah, it's funny. You're not the first guest to mention that about the tall buildings and the banks. It was, I believe it was Brad Smotherman. He does single family homes, but he does a lot of seller financing on them. And he said the same thing. He said, I don't sell, I'm not in it to be a fix and flipper. I'm not in it because, you don't see construction companies, you don't see flippers up on the tops of skyscrapers. You see banks, you see insurance companies. So it's really funny to hear you say a similar thing where he kind of went through the same thing of, hey, I started out as that, fix and flipper construction type mentality. And I forget why he changed. I think it also had to do with 2008 and eventually changed to that model of, hey, seller financing, we're going to basically get a lot of our money back in the down payment from the person. He would actually sell, I think, partial notes to other investors to get all of his money back. And then would also have the note for, the later half of the 25-year note or whatever. So it's just very interesting to hear you guys say the same thing. And yeah, it's definitely very true. John harps on it all the time. Anybody who's listens probably sick and tired of hearing it, but the banks have so much control. We were just talking about it in the last episode. In 2008, they called performing notes. Like you could be doing all the right things and they're going to call your loan and you're going to have to come up with the money. So being the bank is definitely crazy advantageous. I think one thing that a lot of people fail to realize is when you see the debt that you're borrowing, typically it's 3, 4, 5%, something like that. When you get into the non-performing note sector, you can greatly amplify those returns where it makes a tremendous amount of sense. Because I think people are like, oh, why would I be debt and only make 4%? Well, I can almost guarantee that's not what you guys are doing.
Yeah, no, and it's funny because I use the bank building example, but we're not a bank. I mean, we buy paper that banks wouldn't touch, to be honest with you. And that's what creates a great opportunity. But because we are entrepreneurial and because we do have deep real estate experience and in terms of the actual hard aspect of real estate, like fixing stuff. We like fixing stuff, just like you guys, you buy value add apartments because you can add value by fixing stuff, and there's a lot of people, and it seems like the larger you get scale wise with capital, the farther away you want to get from the actual fixing of stuff. So we love we love buying paper that institutions don't want. And if we buy paper that on its face is 7 or 8 or 9% paper, which is pretty typical, but we're buying it even on the performing side. Even when we buy the cash flowing stuff, we might be buying it at 50, 60% of the UPB or the unpaid principal balance. So our real net effective yield is roughly twice that. So we're collecting, and this is real numbers. I mean, we're collecting anywhere from 11 to 17% on our investment. And then when these loans pay off, which they eventually do, some of them pay off every single quarter. Well, they're paid off at the full balance owed, not at the discount we paid. So if I paid $50,000 for $100,000 loan, and all of a sudden I get a request for payoff, like, hey, this borrower wants to refinance, and they have a lender that needs a payoff request by 4:00 tomorrow. Well, I'll get it right over to you, sir. And then we get the $100,000 payoff for the note we paid $50,000 for. So, I mean, we love it. Now, do they break? Yeah, absolutely. A higher percentage of the time than, your bank down in the corner. But again, we know how to fix them. We know how to manage the equity position. And it really makes for a pretty elegant little model. So it's not a huge, the niche that we're in isn't a huge well, but it's a really sweet well. I like to say it's really sweet water. I wish there were oceans of it, but then if there were, we wouldn't have the yields and the margins and the opportunities that we do.
So why would a note that is performing sell for half its value?
Well, because let's just say the people had some, credit problems and they haven't fixed them yet. First of all, every note will sell to somebody. So let me make that straight. But the institutions, further you go up the food chain, the lower their cost of capital is. So if you're an institution, if you even a large hedge fund, and you have access to the through a bank to the Fed window, you're raising money in the very low single digits. Mm-hmm. Why would you go out and buy, quote, risky paper when you can just, collect the difference between, 700 or 650 to 750 FICO borrowers with, equity in their property, a great pay history on the loan, appraisal on the property. Why not do, a couple $1 billion worth of those, and then let guys like Aspen Funds pick up the stuff where, hey, these people were in bankruptcy. In fact, they're still in. We buy a lot of paper in bankruptcy. We love bankruptcy paper because guess what? The borrower is 100% transparent under the penalties of perjury. I mean, we have their access to everything about them financially, or everything that they've disclosed. And so now, does an institution want to buy a performing loan or a semi-performing loan in bankruptcy? Heck no. So, and if we're covering ourselves by, if our investment to the value of the property, we call it our ITV, which is different from an LTV. The LTV would just be the flat out loan balance as a ratio of the property value. The ITV is what I paid for that loan balance as a ratio of the property value. So if I'm under 65% investment to value ratio, really, if you think about it, how can I lose? I'm collecting a high yield, excuse me. If they default, which we don't like to see happen, but it happens, and we can't help them get back on track, we have plenty of room to pursue the collateral and still come out whole and protect our investors' money. And to be honest with you, we actually end up making a profit on those, much as we don't like to do them. I mean, we like to work with people and keep them in their homes. So it's really kind of a win-win. It's a higher touch model than what the big money and the cheap money wants to do. That's the long and short.
What's the typical deal look like for you guys? Because I know, for us, we have our acquisition criteria. Is there a note that's too big or a note that's too small? But what does, when you guys wake up and you're looking at deals, where do those pencil out that 100 out of 100 times is what you want?
Yeah, well, there's a range, but so I'll give you kind of the avatar. This would be we have two sides of our business. We have an income side where we buy existing cash flows, and I just kind of touched on some of that. And then we have the non-performing, or this is kind of we rehab the paper over here and we collect rent on the paper over here. So on the non-performing, we are focused on second mortgages. So it really does vary. The price varies wildly based on the two major criteria that we look at is the amount of equity above the senior lien. So if the house is worth $200,000, the senior lien's $100,000, and we're buying a $40,000 balance of a second on top of that, we have still $60,000 of equity covering our full payoff position. And we might buy that $40,000 loan in a case like that. We might pay 50% of UPB for that. So we might pay $20,000 for that. But there's always other payoffs above the 40,000. That's the other thing. But that's kind of in the high end of the sweet spot. Our typical loan is we pay about just under 20% of the principal balance for. That would be a loan where the senior is performing and we have some equity covering our position, but not a lot. Those are the ones that we call those are the chess game. We don't really have enough equity to know for sure that if we go all the way through with foreclosure, we're going to come out of it whole. But we know that we have enough that we can start moving the ball down the field if we need to, and we're going to engage a meaningful conversation with our borrowers. We really prefer for that to happen on the front end because we have that much more. We have a lot of room to work with these people and make it a win-win. So our typical deal would be we buy it for, say, 20 cents on the dollar. We engage the borrower pretty quickly. We take in a financial intake package just like a lender would do, just like an originator. We send them, a list of HUD counselors. We're very transparent. We're very compliant minded. We're licensed in 50 states, so we're that's taken a while to get there. But, we're very consumer friendly. We're really not out to get people's homes. In fact, that happens less than 1.5% of the time in all the thousands of these that we've done. So back to the avatar here. So borrower engages with us and we work out a loan modification with them based on their affordability. That usually ends up wiping out some of their debt, or we'd like to do forgiveness, incremental forgiveness for every 12 months of successful payments will reduce 1/7 of your arrears and, something like that. So that at the end of 7 years, we've got a beautifully performing loan. They've got equity back in their property and everybody's happy. And in the meantime, we took a 20% of UPB, a 20-cent asset, and we turned it into roughly a 60 to 70-cent asset just by getting it performing. And the way we know that is because we buy those assets from other funds, those reperformers. So we make a really nice return on our distressed mortgage portfolio. And that's if you take the good, the bad, and the ugly and add it all together, we know pretty much what we're going to make on a portfolio of a couple hundred loans, or a $3 million pool of loans that we buy. We pretty much know what revenues we're going to bring in. It's a lot of work, and we have a very skilled team of workout agents that really know how to play financial chess. Mm-hmm. And really care about helping the people on the other end of the deal. That's super important to us. In case that hasn't come across yet, that's real important to us. And we have to serve our investors. We're a fiduciary to our investors, but we also really care about the folks in the homes. And we want to make it a win-win. And so far that's been the way it's worked out. So
I'm sure because I have a buddy who does this. He was actually a lawyer, and he ended up, his law firm got bought by a real estate investor, and all they do is buy, non-performing, performing loans. And, keeping someone in the house paying work, because each state's a little bit different with their foreclosure rules, especially now with Corona and what you can and can't do. So I'm sure you guys have an area that say, I really love Texas, I hate New York, right? Because I'm sure there's areas where, if it gets ugly, it's a pain in the ass. So keep
that just coincidental. Were those two random states you threw out, or are you?
No, I know Texas basically has no rules, and New York is the worst place in the world.
Yes, sort of. Yeah. No, we definitely do have favorite states, and the market has definitely gotten pretty sophisticated. When I started into this, and there's been people in this space forever. But I mean, a whole bunch of people came in as a result of the mortgage crisis. Because, with this, just the kind of thing you guys are doing here. I mean, everybody can become an expert at everything. And I say that in quotes, but you have access to the training and the information for real. So there's just been tons of people jumping into this space, everything from brand new to large hedge funds that are like, hey, show us how to do this and we'll put money behind it. So you figure out as you go which states you want to. Now, we can't always choose because we're big enough now that we buy, we do bulk purchase almost all the time. Every now and then we'll cherry pick, or we very rarely buy a single note anymore, but we're able to, and we're willing to, especially to build the relationship with that seller. The thing I like about this business is just to contrast it with, say flipping houses or even buying apartments, which by the way, I think is an awesome model. And it's probably what I wanted to actually do when I grow up. So you guys are doing it. So, But here's the deal. I mean, if you find a deal out there, like a distressed seller, whether it's single family or multifamily or commercial, you talk to a whole bunch of people, kiss a bunch of frogs, find that deal, pencil it. It ends up being a deal. That's great. But, typically those are not serial sources. In our world, when we buy a deal from somebody, typically it turns into a relationship that we don't have to reinvent. And we know each other. We know what our pricing expectations are. Sometimes that seller needs capital more urgently than they care about squeezing the last dime out of it. So they'll say, hey, if you can take down this whole thing, if you got $5 million cash, I need this money to put into another deal. And I'll look at those loans and say, man, we just got an extra 20-25% bump on these just for buying them. And we love that because it's managing a handful of really good relationships rather than, okay, back to the drawing board, let's go find our next deal. So again, every model has its pros and cons, but that's one of the things I really love about the paper space is you have serial transactions with the same parties. So.
Yep. That's even my buddy who's an attorney. He's done this. He has the same group of guys that keep sending him deals. Yeah. And it's very easy to transact because they know, hey, this is what we need. Or like you said, I need the capital now, whatever it is. So it makes life super easy because it's a couple of sources and you're not always going fishing, right? You're always checking something else and trying out. It's a little bit more calculated, more or less, after you've transacted and they know how it works and how you are and how you operate as a buyer. It makes life easy.
Yeah, and we have a pretty stellar reputation for doing what we say we're going to do when or before we say we're going to do it. We really like to beat our deadlines, and we do. And there's not a lot of drama. If we bought some loans that turned out to be, oh man, these had way more hair on them than we thought, unless it's just a clear violation of one of the reps and warrants from the seller, we're just going to eat it. We're going to eat that loan and we'll let them know and say, hey, maybe on the next deal we can kind of, make this right. But, we're really easy partners to work with. Again, we're very relationship minded. So that's another fun aspect of this business.
So for that, just so I understand, for that seller, when they're selling a bulk portfolio of 3-5 million, is that like they bought 10, 20 times the amount and they just knew they were going to write off a certain amount of loans as ones they were going to sell for a discount because they're just at a higher level and they just knew something was going to work out? Or, did they fail? Like, what is that relationship?
It can be that. I mean, there's all kinds of different reasons people sell. I mean, there's brokers and intermediaries or advisories in our space that we do transact a lot of business with, and they just build relationships between would-be buyers and would-be sellers. And the cool thing in our world is really, in a sense, everybody's a buyer and everybody's a seller, just depending on what you have more of this particular quarter, deals or capital. So we're all selling and buying back and forth. So those guys do really well. But a typical, like if we buy a carve out from a larger, like you mentioned, Chris, from a larger pool that say a large hedge fund takes down, they're getting commercial paper, single family, tiered single family, like high value single family and Rust Belt low value single family. And then they're getting these second mortgages, which most of them don't. If they cared about doing something with them, they wouldn't know what to do with them. And it really takes a very unique wheelhouse. And that's really our niche. And that's why we've been able to really prosper in that niche, because typically it'll be somebody like, look, I have all these seconds, and I know there's a handful of buyers out there, but you guys have been really good to do business with. What kind of price do you want to work out on these? And then we'll get the whole deal. So to us, that's a big pool. To them, it's like let's carve this off and get rid of it because we don't want to deal with it. We're in the middle of a trade like that right now. That's papers coming from a major bank, and we just this one guy that's putting the deal together said, "Wow, you guys like seconds? We love seconds, man. Send them to us." So it works out that way. So
gotcha. And what do you guys look for on exit strategy? Are you holding until they mature? Are you looking to get them performing and offload them? Like, what does the exit strategy look like for?
Yeah, on the non-performing loans, anybody that's holding them till they mature is hasn't been in this game too long, because there are such thing called statutes of limitation, and your attorney buddy John would know this, and that they're different in every single state, and there's 2 or 3 different aspects of statute of limitations you have to look at with each mortgage, and it can get very complex, and you can learn some hard lessons. So, and plus the fact that we're kind of a velocity model, so we want our capital working on that side of our business. So we don't always know what the exit strategy is going to end up being on a particular deal, because a lot of it has to do with what that homeowner's posture is with respect to the property. Now we can have a realtor drive by and tell us, hey man, we can look at our AVM, see what the property's worth. And you can tell a lot by looking at the outside. If the house is, if the flag's up, the lawn's mowed, the toys are put away, the cars are nice, chances are the inside of that property is not trashed. And also chances are they're not going to go anywhere. Even if they're upside down in the property, if they're employed and they're making the payment on the first, we're going to be able to work with them. So we always start down the path of, hey, how did you get off track? How can we help you get back on track? What's your game plan? Send us your finances. If we don't get a pretty immediate response and we have a ton of equity, we will engage an attorney, and we'll do the first step, the default letter. And so we'll start marching down the foreclosure track on those, because I hate to say it, but probably 75% of the time, that's the way we're going to end up having a meaningful conversation with this borrower, is by showing that we really can do this and we plan on doing this. And it's amazing how many people out there, even in our space, don't realize that you can foreclose from second position. And, a lot of people have to find that out kind of the harder way. So, so we don't really know. So, but I can tell you how it shakes out. 60 to 70% of the time we end up with either a discounted cash settlement from these borrowers, because they realize, hey, I got an uncle, I got a 401k, I got a family member, or I've got the money sitting over here and I was just waiting for somebody to call, because usually with these second mortgages, they haven't heard from anybody, in some cases in 7 years. They haven't heard boo, So we settle them, or a large percentage of them we do a loan modification with. In some cases, we help them do what I call a friendly short sale. So if you know anything about how the realty world works, as a realtor, you never want to list a house as a short sale, because you just boxed out a large percentage of your buyers or the agents that are representing those buyers, because it's too much of a risky, it's too much brain damage of a transaction rather than a fair market transaction. So when I say a friendly short sale, we will give them ahead of time a discounted payoff, which will allow for the property to be priced at market value, and nobody's getting shorted. We're putting in a demand, so to speak. So in other words, if they can hit that number, you don't have to negotiate with us. and that takes a lot of the pressure off on the buyer's agent. So that works, a handful of times every quarter. We get a few of those, and then unfortunately we do have non-retention options that end up happening, whether we either take the property back through foreclosure or we do some sort of a deed in lieu. And again, that's very rare. So, and then we resell loans. So if you add all of those, exit strategies together, that pretty much makes up our full, our full portfolio. And we're always rolling these through the process. So we have a lot of people to keep fed in our organization. So we need to get the capital. We need to keep the capital rolling and moving on. So.
Mm-hmm. So it sounds to me, like if you're buying a $3 million portfolio, you could have dozens, if not over, 100 loans. It sounds like there's a lot of work that goes into each one of these. How are you able to keep up with, staying in touch with 100 homeowners and going through multiple different strategies and everyone's unique? Like that just sounds like a lot of, man hours or things going into it. Is that the case, or does it?
We have a team. Yeah, we have a team of what we call asset managers, workout specialists, and also with some dedicated administrative assistants. So we are forever improving our models and our workflows, and that's actually one of the pieces that I work on that I really enjoy. I think my project management experience helps me there. But we have some of the just sharpest people that have been with us now for 6 years plus, and some of them newer. And so each one of our workout reps or asset managers has, anywhere from 100 to 200 loans that they're responsible for at a given time. Now, most of these, obviously they're not required. They're not all requiring daily action. Mm-hmm. So you have to learn in that position how to prioritize your time. And if it's a $20,000 loan or payoff, you don't want to do the same depth of analysis that you're going to do with a $150,000 loan. So our loans average, to be honest, they average between $40,000 and $50,000 balance, maybe 50 to 60 nowadays. And so, that can be a really nice and sizable payoff for us, but we have a bunch of them that are $10,000. And those are ones where make a quick phone call, write a fast letter, and we can get a fast settlement and triple our money and, whack 70% of their debt off of them. Everybody's happy, move on. Don't spend a whole lot of time on it. So managing that time, you really hit it. You really hit a great question there, because that is the secret sauce and the magic of our model, is being able to touch a whole lot of files and know which ones need to get, sent to the attorney right away, and which ones, no, I got meaningful dialogue going with this homeowner. And then there comes a point in time, honestly, where it's like, look, I don't need verse 3 and 4 of a country Western song. I already heard your story. We're empathetic. We want to work with you, but, and you have those kind of people that pop up. It's just, it's like, look, I'm not in this for a lifelong relationship. Let's get a deal done and move on. So it's managing a lot of moving parts.
I hear you. I do want to take it down a little bit, because I'm sure there's newer people listening and maybe want to start learning more about it, or even possibly, looking to get involved. For the individual person or the smaller investor that's not taking down $3 million worth of stuff, how does somebody break into the space? Where do they start looking for opportunities? How do they meet brokers, agents, intermediaries?
Yeah. So great question. And I'll just tell you how I did. Again, I knew nobody in this space in 2010, and I went to a conference, and I continued going to note conferences. And I know we're in COVID, but there actually are, most of the conferences have moved online, and they're actually, you guys know this, but they're actually pretty elegant. They do a really good job. It's not as much fun as going out and catching a beer with people that you just met. But honestly, the education is out there. I would be happy to direct people personally if they, want to hit up our website. We don't do training ourselves, but I know people, I know trainers. So there's people out there, coaches and mentors that take on students that are literally going out and want to buy their first loan, whether it's performing, cash flowing, or whether it's they want to jump into the non-performing world. So I can definitely help direct people there. You could even get online and do a search, and you'll find some of these note coaches. But I can kind of tell you who I would suggest avoiding and who I would suggest hooking up with, the real deal players. I know most of these guys and have a pretty good relationship with them. Some of them I have a great relationship with. So, that's definitely the way to start, is just start networking with people that are already doing it. And, if you have a little bit of capital or a little bit of energy you're willing to put in and use somebody else's capital, there's all kinds of people really willing to work with and to mentor folks like that. So we don't really do the mentoring piece, but I'm, very open-handed about where you can go find the best mentors and get some great information. So a person can get started in this business, honestly, and get up to speed pretty quickly if they have what it takes to go for it. So.
Gotcha. Awesome. I do want to ask, just because we haven't really spoken to anybody about it, and John touched on earlier, but how has COVID, the foreclosure moratoriums and restrictions impacted your business and your business model?
Yeah, I mean, this almost sounds ridiculous, but we've just come through two of our best quarters ever. We've doubled in size. We've doubled our growth, our revenues, our number of exits. We just had an all-time high last quarter. Mm-hmm. I don't really know how to explain it. I talk to people in the real estate investment world, and honestly, I have not talked to anybody yet. I'm 63. I'm not out networking all the time, but I talked to a pretty good number of people, and I have not run across one yet that said, man, COVID buried us, or we're bailing out. We're losing our investors. We haven't missed a preferred return payment to our investors ever, including through COVID. We actually hired, it turns out to be over 25, is that right? Roughly 25% growth in our staff during COVID. And this is like training them and helping them get started at home. And we do have an office, a really nice office in Overland Park, Kansas is our headquarters. And we just added new space. And now we're moving to yet a larger space. So it really hasn't affected us. And I think largely that's because the states that we're in, like 38 states, but the housing that undergirds our model, it's pretty much workforce housing. There's been a lot of loss of employment, but so far so good. We've had a handful of people that have requested forbearance, and we've worked with people, but even some of the people that got approved for it just kept on paying. We actually live in, despite what things would look like on the news, we actually live in a really good country, guys. People for the most part are still pretty darn good and pretty honorable. Mm-hmm. And there's always a few that, if we're not careful, we can get a really jaded view and think that, the sky's falling. And I know this COVID thing's been super serious. We just actually, one of our employees literally just within the last week lost his dad to the stupid thing. So it's a real deal, but as far as our business goes, it's just, we've been super blessed through it. And and I think all of us are going to be coming up out of this thing pretty strong here in the next several months. So
interesting. As we're wrapping up, I'm curious too, because you were just talking about preferred returns. What are typical, what returns do you guys look for? How do you structure it? Because I think a lot of people hear and know kind of what similar, multifamily guys are looking for typically out there. How does it work in your world?
Yeah, in our world. So first of all, I have to, disclaimer, this isn't a solicitation for investors. Our funds are at this point only for accredited investors. So we use a 506c and all of that kind of thing. So, but what we do on our non-performing side, we actually have we have equity investors, and there's a profit split with those guys, and they along with us get our profit at the tail end of the deal. And now we have some institutional senior debt facilities that they get the first money back out of the deal, but it's cheap money for us, in this, think about it, we're buying non-performing second mortgages. So, but at the end of the day, our investors, our equity investors, if they don't need their cash, it's a low liquidity model. They put their money in, and by 3 years later, they'll have everything back plus their profit. But we're hitting high teens to low 20s as a target IRR. I think similar to a lot of the value add type apartment numbers. I think a lot of the people that invest with us probably do multifamily, and they probably diversify into some other models. And then on our income model side, we just pay a straight preferred return, and it's in the plus or minus 9% range, depending on the size of stake a person wants to take. And we're starting to play with some timed investments too, like the longer term, you'll let us use the money knowing that we have it. Maybe the rate's a little lower, a little bit higher if you want to back out in a year, that kind of thing. We're starting to play with some of that, but we've just we're just continually growing. We've brought on some people that are dedicated 100% to raising capital and establishing institutional relationships for us. So we're going to need some bigger business models to move into here pretty shortly, as a matter of fact, because of the way that side of our business has been growing. So we'll probably be doing more in the senior mortgage space and maybe commercial mortgage. And actually we're looking at some hard asset real estate plays as well. So that we'll be moving into.
Awesome. Beautiful. I do just want to be conscious of time. I appreciate you coming on. I think people are going to get a ton of value out of this episode. So can't thank you enough for coming on. If people want to learn more about you, your company, get in touch with you, where can they do all that?
They can go to our website. It's the best way. And then just fill in some information. Let us know what it is you're looking for. But aspenfunds.us. So it's one word, ASPENFUNDS.US. And you can just say, hey, heard Jim on the podcast, would love more information on, getting into the note business or regarding your investments. If they're accredited, they can request that and somebody will reach out. So
beautiful. Guys, definitely go check it out. Go hit them up if you have questions. There's a ton more about the world, so you can definitely learn a bunch from him. And thank you guys so much for listening to this episode of the podcast. If you're not already subscribed, it would mean the world to John and I if you would do so. And if you are, please send to someone that you think would get a tremendous amount of value from this episode with Jim. Once again, Jim, can't thank you enough for coming on. This was awesome.
Hey, great being with you guys. Thanks.